Good afternoon. We are gathered here this afternoon to talk about our financial audits for 2015, both the city and the Public Utilities Commission. And what I want to do is just introduce Kyle Myers from Abdo Eichen Myers, our auditors, and he'll go through a presentation. Thank you.
Thanks, Reg. Good afternoon. As Reg said, I'm Kyle Myers from Abdo Eichen Myers, and I'm here to go over the results of the 2015 audit. What I've put together in the slide presentation is some highlights of the financial position of the city, and then some graphic information on the individual funds, highlighting some of the changes in fund balance or changes in financial position or cash flows of the various funds. The results of the 2015 audit is that the audit opinion, which is in both financial statements, is a unmodified or clean opinion. There were no material weaknesses as far as current year findings. There was one prior year finding that was resolved. You had a material audit and accounting adjustments related to unrecorded governmental receivables related to the airport projects. That was a last year finding that was corrected this year and recorded properly. Here's some changes in financial position, the city and its component units. Keep in mind that the city is independent of the Public Utilities Commission and the EDA. So when you talk about component units, it's the PUC and the EDA. Net position increased by 7.8 million, about 4.8%. Governmental activities, which would be mainly the city portion, is 4.4 million. The PUC's was 3.1, and the EDA was 252,000, and the EDA's year end is June 30th, so those financial statements were audited with that fiscal year end, June 30th of 2015. As of the end of December, the city's governmental funds reported combined ending fund balances of 25.3 million, an increase of 2.3 million with the prior year. Increase mainly due to collection of previously forfeited assessments and prepaid assessments, very strong sales tax proceeds, and of the ending balance, about 4.7 million or 18.5% of that 25 million was unassigned available for spending for the city. And that's mainly what's in the general fund. I believe there's maybe some deficits in other funds, but the general fund makes up most of that balance there. There was two new standards that were implemented during 2015, and we talked about this last year, the pension standards, where basically the city, the Public Utilities Commission, and the Economic Development Authority reported or recorded your proportionate share of the unfunded pension liability at the state level for both for the PARA, the General Employees Fund, Police and Fire Fund, and then the Fire Relief Association is also included in these standards. So you'll see in your notes to the financial statements, there's a lot of detailed notes on the pension standard. I believe it's note 4, if I'm not mistaken. Yes, note 4, starting on page 33 of the city's financial statements. You'll see a lot of detail on those disclosures. General fund unassigned fund balance is a percentage of next year's budget. You can see that over the 5 years, past 5 years, the city has ranged between 47% was this year's ending balance, last year's was 73.5%, and it's been consistently in the 50 to 70% range. So pretty good reserves there. The state auditor, League of Minnesota Cities, recommends that the fund balance levels be at anywhere between 35 and 50% of planned expenditures for next year's budget. Basically because of the fact that you get your state and state funding and property taxes kind of like in May, June, July, and then November, December. So you need that 5-6 months of reserve, which would be approximately that 35 to 50% level. One thing I want to point out, well, let's see, on for your general fund balance, if you look at the in the actual management letter, it shows that you have 5.5 million of unassigned fund balance, but your actual fund balance is about 7.5 million. You have about $2 million set aside for this next year, the 2016 budget deficit, which you're using to buy some land. So the effect of that $2 million assigned has no effect on that number, so that number will remain at 47.5% or possibly change, fluctuate a little bit, but the purchase of the land was budgeted or assigned use of assigned fund balance rather than unassigned fund balance. So keep that in mind. Also, the total fund balance of the city is at about 76%, 75% of the expenditures, including the $2 million that I was referring to. And that's right in line with other similar sized cities in the state of Minnesota. You're right around that 76 and 74%. That's the average of the other cities in the state that are similar size to the city of New Ulm. General fund operating budget. Just in summary, your revenues, expenditures. Your revenues were almost 540,000 over budget. Your expenditures were 568,000 under budget. You underspent that, so they're positive variances over here. So overall, with the netting of these transfers here, you had an increase in fund balance of 397,000. The budget had a decrease of 637,000, and your variance was a positive $1,034,000. So it's a combination of more revenues than anticipated, and you underspent your expenditure budget by about $500,000. This shows a 3-year history of your general fund revenue sources. You have your taxes, which is right in line with your intergovernmental, which is mostly local government aid. And you can see this kind of leveled off, and your intergovernmental decreased from 2014 to 15. Now there may be some other intergovernmental in here besides local government aid, but nonetheless your revenues did decrease in intergovernmental, and looks like property taxes had a slight increase or almost level from 2014. And your other revenues, which would be charges for services and everything else, is pretty level over a 3-year period. Your expenditures by program, your public safety is your highest expenditure, and that's right around the $3 million level, slight increase from 2013 to 2015. Streets and highways looks like it's fairly level over the 3 years. General government, fairly level with looks like a slight decrease from 13 to 14 to 15. And then other would be possibly culture and recreation, and then airport possibly, if they're not in any special revenue fund. So that'd be all the other expenditure functions within the city. Looks like you've got just sanitation and waste removal, miscellaneous, capital outlay, and transfers would fall in that other category. Your special revenue funds, pretty good balances, about $9 million total in all the funds. The biggest change here is your sales tax revenue fund, where you generated $518,000 more in revenue than expenditures. So you had an increase in fund balance of that for a total increase of $699,000, almost $700,000. And then secondly, your Parks and Recreation fund had an increase in fund balance of $185,000, and it's at $1.8 million. So overall, pretty good fund balances in your special revenue funds. Debt service funds. Again, this shows all your outstanding obligations that are in the city, nothing to do with the PUC or the EDA. So basically, here's your outstanding debt, the future interest on that debt, and the cash balances in the funds in total is about $2.5 million. Total assets is about $6.9 million, with the main difference between these two about $3.4 million being future special assessments to be collected in your debt service fund. So again, overall, looks like your funds are in pretty good shape as far as funding your debt service obligations. Here is your 10-year history for your principal and interest on debt. You can see you're currently at about $3.6 million principal and interest coming up in 2016. Again, that continually drops as some of those previous bond issues are paid for, depending on what their maturity dates are. And again, if you want to look at the details on your debt, that would be a note in the financial statements to look at all these obligations to see when they're due. But typically you can see from here that you do have room for some replacement of debt or issuance of debt for future improvements within the city in future years. Capital project funds. Again, the top line here, capital improvement revolving fund, has a fund balance of a little over 5 million. It increased about 857,000 over last year. You have one fund that has a deficit, the airport runway extension. Again, as that project completes, you'll either have some more grant revenues coming in or expenditures, and then you also have what's called the local share that will be funded probably by the general fund or another fund or possibly the capital improvement fund to fund the local portion there. The city has done a pretty good job of cleaning up your completed projects. You can see that there's 3 projects here: the 2013 bonds, the levy project, and the 2012 bonds that no longer have fund balance, so those funds were closed during the year to other funds. Now we get into the utility commission funds, and here we stress cash flows and your cash balances. The thing to look at on these graphs are the blue bar is your rates or your charges for services, the gray bar is your operating disbursements, and the green bar is your debt service disbursements. So, ideally you set your rates to at least cover your operating cost and the debt service requirements. And then any excesses beyond that then are your money that you're putting away for future capital replacements. So you can see in all 4 years, the blue bar does exceed the gray and the green for the electric fund. Again, what might be in the burgundy or a small portion here would be like capital outlay, possibly interfund transactions, and what might be over here might be debt issuances or interest income, something that would not relate to operations, but it's a pretty small portion. You might see it in some of the other funds a little bit clearer. The result of the cash flows of the electric fund for the last 4 years is that you had a cash balance of 3.5 million 4 years ago, and now you're at 3.7. Some of those funds were used up in 2013 and 14, and now you built up some funds. So you have about $3.7 million in cash. The targeted balance here would be based on a cash balance based on 35% of your operating costs, which would probably be about a 4-month reserve in operations. 4 months would be 33%. Could be 33%, and that's what's a little bit over 4 months. And then 1 year's debt service payment. And here's the bonds payable in the electric fund. You can see they're declining over the 4 years from 5.2 million, almost cut in half to 2.5 million in 2015. The district energy utility fund, again, the blue has exceeded the gray in all 4 years, and it looks like from this your total receipts have exceeded your total disbursements, so you should see cash balances increasing there over the 4-year period as they have. You have 1.5 million 4 years ago, and it's steadily increased to about 2.2 million. The minimum requirement there with the 35% plus the debt service payments would be about 275,000. So you've got about $2 million, this gap between that line and the top of the bar here, that you could use for capital replacements without having to borrow if you choose. And that's the purpose of having those excesses there to fund future capital needs. The natural gas utility, again, you can see there over 4 years, there's a slight increase in the blue bar over the gray and the green. So there again, you should see your cash balances increase over the 4-year period, which you can see that they have done from 5 million, just under 5.1 million to just under 5.8 million over the 4 years. And your requirement, based on the same concept here, 35% of the operating costs, you have about a $3.2 million capital reserve set aside there in the natural gas utility fund. The water fund, again, if you just look at the blue and the gray and the green, pretty good rate structure there to cover your costs there. Again, you've had some bond issue costs, some capital replacements within the water fund. That's what most of this burgundy bar is on the left side under your disbursements. And again, as you would see there, your cash balance has gone from 583,000 4 years ago, went up to 2.9 million, but that was basically because of some bond issuance. And now, as those are spent down in the subsequent years, your cash balance has decreased to just above $2 million. and the minimum requirement is just below 900,000. So you got about a $1.1 million reserve there in the water utility fund. The wastewater cash flows, again, looking at the operating receipts compared to your operating cost debt service are good for 4 years. Cash balances pretty good. 4 years ago you were at 5.7 and you're at 5.4, so up and down over the 4 years, but a lot of that has to do with capital activity, because as you can tell from the previous graph here, your rates are sufficient to cover your costs there. And again, your bond balances have decreased over the 4-year period from 4.7 to 3,046,000. These are the combined cash balances over the 4 years. You had started ended 2012 with $16.5 million, and now you're at about a little over $19 million. So about a $3 million, almost a $3 million increase from 2012. Your minimum requirement for all funds would be about $12.5 million, and you're at $19 million. So you have some excess reserves there to fund some future capital expenditures within the fund in the near future. Are there any questions on anything I've gone over so far, or any of the discussions on the funds? Now we're getting back to the internal service funds of the city. You have an equipment revolving fund, health insurance, and the insurance fund, and overall they have pretty good balances here. Had increases during the year of $369,000. You know, again, with your health insurance, that could be something that they're self-insured, so you could have some claims in there in any 1 year that could wipe that out. So it's always good to have some good reserves in your insurance funds there. But as it looks right now, it looks like that seems to be adequate. Now we have some peer group ratios comparing the city to other like-sized cities in the state of Minnesota. First one being your debt to assets ratio. You can see the city is lower than the peer group average at about 20%, been pretty level over 4 years. The peer group is about 31 to 33%. Your debt service coverage has been pretty steady at right around 2 to 1. The peer group's a little bit less than that at about $1.40 to 1.4 to 1. Debt per capita, right in line with the peer group, and it has been decreasing for the city being on the top here and the peer group being in the red. So you're at 2,407 per capita, and the peer group's at 2,369, and that was a year ago. We don't have the 2015 data yet. Taxes per capita, pretty steady increases over the 4 years within the city. A little bit higher than the peer group, but keep in mind that the public utility, there's some internal activities here because the Public Utilities Commission does have a payment in lieu of taxes that it pays to the city, and that's included in that $750 per capita. So that's a tax, so it's included in taxes, but that's probably why it's not apples to apples, because you have that in your taxes and some others may not have that same revenue source. Current expenditures per capita, these are all your governmental funds. You're at about 1.2 million. Peer group's at about 650. Again, some of these maybe aren't always apples to apples either. You've got, recreation, a lot of recreational activities in your governmental funds, where other cities may not have as much as you have in your recreation funds. Capital expenditures may be up or down in any 1 year, as shown here. You had 840 per capita 4 years ago, and in 2015 was only $189 per capita. These next two ratios show how new or old your capital assets are. You're right in line with the peer group and your governmental assets. You're at about 60%, where the peer group's at 58. That means that you have 60% of your assets left to depreciate. So if you paid $1 million for an item, that means your book value is $600,000. Let's say it was a 10-year write-off. That means you have 6 years left to write off. If that's just an easy example to think of this as. And your business type activities, which mainly would be your Public Utilities Commission, are at 42%. And that's pretty steady over 4 years for the city here. And one thing I have noted when you bring in electric and some older infrastructure into the system, that percentage seems to be lower when you have public utilities that have electric utilities. So that's pretty consistent with, as you'll see when we get to the just the utility comparisons. Any questions on those ratios? Okay. And again, as noted here, it includes the PUC and the EDA, so it includes everything within the city reporting entity. Here's just the public utilities ratios. Your debt to assets is about 18%. The peer group's at 22%, so just a little bit lower than the peer group. Debt service coverage consistently at 2.2 to 1. Peer group up and down over 3 years, but that's a pretty good steady number there. Debt per capita right around $1,000. Peer group was a little bit lower in 2014, but pretty comparable to the prior 2 years. And again, your capital assets left to depreciate, you're at 42. Peer group's in the 40% range. So as I mentioned, you're right in line with most other public utility commissions. This is more just informational. Future Governmental Accounting Standard Board statements. There's some here that are, you'll notice we talked about GASB 67, 68, and 71. Well, there's a modification to those that, they probably issued the statement, found out some flaws in there, so they had to make some amendments to that. Also in here are some OPEB changes for accounting for post-employment benefits other than pensions. There's 2 of them right in a row there. There's one on tax abatement. Again, there's pension standard, and then some investment pools and blending requirements for certain component units. This last one basically deals with whether to include or exclude the Public Utilities Commission or the Economic Development Authority, because it's part of the reporting entity of the city, but it's discretely presented because it's a separate legal entity. And you have separate, there's certain criteria that make it as a discrete presentation. So there's always these requirements for either whether you show it blended or discretely presented. So in the case right now, the EDA and the Public Utilities Commission are discretely presented in the financial statements. They're not part of the governmental operations. Any questions on anything there? It's mostly for your finance people to understand these things. So I know Reg has already asked about the tax abatement, and we usually do a client training in the fall with any new GASB statements that are coming due. So I'm guessing this fall we'll have the training on any of the ones that are, and you can see the dates here those are applicable. You got that one in 16, that one in 16, and a couple here in 16. So about 4 statements there that are applicable for this next fiscal year. So. Again, thanks again for the staff and their help in preparing for the audit. They do a great job, and we appreciate that. And thanks for the opportunity to work for you. Again, if there's any questions or discussion, I'd be glad to talk about that. No questions? Okay. Yes. Is
there a list of our peer groups somewhere?
I think it's listed in here. It's not detailed, but here's what I can tell you. On page 19 of the management letter, I think it should say it in there. No, it doesn't really say it, just Public Utilities Commissions. I don't know if the city has one on there either. Well, city, it just says cities of the third class population, 10,000 to 20,000. So, you're looking at, outstate, you're probably looking at maybe like Fairmont, Hutchinson, New Ulm, Red Wing, Northfield, or whatever. If Northfield's, I don't know if they're under 20 yet, but it'd be those types of cities. And possibly some metro cities too that are in that population range. So it would include all populations. This data can be scaled down to whatever, if you want to do the regional centers like the first ones I mentioned there, we can just extract the data for similar size outstate cities too and make that data comparable too. It's just we've kind of done it all for, hey, we just break it down into population groups and try to get the small cities, the medium, larger, and then the really large cities. So. Thank you. Yeah, thank you.